You know, we all want to retire comfortably, but the question becomes, what does comfortable really mean when it comes to retirement? And how does it help you to create a plan that achieves that comfort? You guessed it, it's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Hello, I'm David Scranton, and thanks for being here with us today. Unfortunately, there's no magic formula, no silver bullet for comfortable retirement. However, you can greatly boost your odds by making sure that your strategy includes certain key ingredients. And today, we're going to be taking a look at the 5 keys to planning a comfortable retirement. So specifically, we'll cover having a holistic retirement plan. Also, having a plan that aligns with your goals. Having a plan that minimizes stress. Having a plan that sees over 200 miles ahead, figuratively speaking. And last but certainly not least, having a plan that's flexible. And helping me out as usual will be income specialist and best-selling author Jeff Small. And we'll also hear from financial analyst and commentator Dr. Gary Shilling, as well as other income specialists, Andrew Agemy from Connecticut and Michael Burleigh from Florida. But first, let's take just a couple minutes and let's talk about what we mean by a comfortable retirement. And also, let's discuss the importance of planning this retirement, what we call holistically. For most of us, comfortable doesn't mean lavish. Comfortable means stable. And if you're like most people, you want a retirement that allows you to live the same lifestyle that you're accustomed to and to do all the things that you've never had the time to do while you're working. Things like traveling more, or spending more time with family, or any other activities that give you fulfillment. Maybe work is one of those things that gives you fulfillment and makes you happy. And that illustrates why it's important to take a holistic approach to retirement planning. So what do we mean by holistic? Well, to me, it means planning a retirement that accounts for every aspect of your comfort. In other words, not just your financial health, although that's what we tend to focus on here on the show, but also your physical, your mental, and your emotional health. So if your job is the most fulfilling part of your life, and you retire without knowing how you'll fill that emotional void, then it's not going to matter how much money you have or how it's invested. Your retirement simply won't be comfortable. Why? Because you'll be restless. Or if you have another passion, but don't have a financial strategy that provides enough income to pursue it, then you're going to be frustrated on a different level. And again, your retirement will leave you feeling unsatisfied. So now I can hear you saying, well, gee, Dave, that sounds great, but how exactly do I go about that? Well, that brings us to the second key to planning a comfortable retirement. And that is making sure that you have a plan that aligns with your retirement goals. Now, naturally, you can't do that unless you previously identified your goals, right? And that's really where retirement planning should start. In fact, we're going to be talking about that between Jeff and myself coming up in just a moment. But before I bring in Jeff, let me take a moment to answer one of your questions. Al from Illinois says, Dave, my wife and I are in our early 60s and have a pretty good savings. We'd both like to retire soon, but we're scared we still don't have enough. How can we be sure? Well, Al, in previous shows, you probably heard us talk about top-down analysis. And basically what that means is taking your income right now, subtracting from it expenses that might go away when you retire, and coming up with a number that you're going to need for income during retirement. But then subtract from that number your known income sources, like any pension plan income that you might be fortunate enough to have, your Social Security income, any rental income. And whatever is left has to be satisfied from investments. And if you're allocated perfectly, and that's a big if you're allocated perfectly, you take your investment balance, multiply it by 0.04, and that's how much income you can generate from your investments. If that fills the gap, then good for you. If not, then you may have to do some damage control. Now, be sure to submit your own questions to Ask Dave by emailing me at askdave@theretirementIncomeStore.com. Now it's time to bring in 2 special people. First of all, my good friend and co-host, Jeff Small, an income specialist from Melbourne, Florida. And also our first guest, Dr. Gary Shilling. He's a financial analyst, a commentator, and the president of Gary Shilling and Company. He's also the editor of Gary Shilling's Insight. Professor Shilling, thanks so much for being back with us here on The Income Generation.
Glad to be with you.
So, Dr. Shilling, what's the top piece of advice you can give our viewers and our listeners on how to create income when they first get into retirement?
Save more. You know, most people, what they end up with at the end of the day when they go into retirement is what they saved, not what they made through investments. Yeah, sure, investments are fine. They do improve the situation. But if you look back historically, when people have assumed that investments were going to do the job and they saved less, they usually were setting themselves up for disappointments. That happened in the 1990s. You had 5 years of the S&P 500 rose over 20% in 5 successive years, and people cut back on their saving, but they learned to regret that. So you do need investments, but you can't rely on them to do the job.
That's a really good point. I kind of feel like we're at the end of the 90s again with this all-time market peak. Do you feel the same way?
Yes. I mean, if you look right now, and I'm looking at a sheet here of price-earnings ratios for the NASDAQ, the S&P, and the Dow, and they all are about twice. They've just about doubled in the last year, ever since things took off back in March with all the monetary and fiscal stimuli. But they're way, way above any historical norms. And I think it makes investments in equities very risky.
Yeah, I agree with that sentiment. I guess the COVID economy and the rise of the NASDAQ and the digitization side of the economy occurring really facilitated growth in that sector. And this year it seems to be a rotational move into value type based stocks and away from the high flyers of last year. And so when does this trend end? When do you see this bubble popping? Because obviously we're creating this huge asset bubble.
Well, you have had a rotation. You did have the tech stocks flying, but one thing that we pointed out in our monthly newsletter that you mentioned, Insight, was that a lot of the value of tech stocks is the discounted future earnings. And because most of them, their earnings are way, way out there, many years out. Well, the higher the interest rate, the less those earnings are worth presently. And that's what one theory is, that's what constitutes the stock price. And of course, many people are looking for higher interest rates, and they have risen a bit in the last year. And I think that's put a damper on the tech stocks. And you've also had the rotation to the more economically, fundamentally based stocks because of the anticipation of a big surge of consumer spending on reopening the economy.
That's right, the recovery, the big recovery trade, Dr. Shilling. So all great points, Dr. Shilling, Jeff. We can take commercial break. Look forward to having you back just after the break. And you stay with us. We're going to talk more about your money and talk more about the things, again, you need to know to have a stress-free retirement. We'll be back in a moment right here on The Income Generation.
Women are an economic powerhouse. We earn, control, and inherit more wealth than ever before. Our lives are truly a balancing act. It's not easy to juggle a career, a marriage, caregiving, and other life transitions. Yet we always rise to meet the challenge. Take charge of your retirement planning today so you can leave a legacy for your family tomorrow. Download our free Women and Wealth Guide to Retirement Planning. Find strategies to help grow, manage, and protect your assets. Visit womenandretirementnow.com.
Welcome back to The Income Generation. I'm David Scranton. Of course, I'm here with Jeff Small and today's special guest, Dr. Gary Shilling. Dr. Shilling, thanks so much for sticking around.
Glad to do so.
So, Dr. Shilling, we've been hearing a lot of talk about potential inflation, but you said you see deflation more likely. Can you tell us why?
Yeah, well, inflation is fundamentally a matter of demand exceeding supply. Now, that typically happens in wartime when governments are spending a lot of money on top of a fully employed economy. Demand exceeds supply, you get inflation. But today we have globalization. You have a huge production in China and other Asian countries, and they're big producers, big exporters, but they are very parsimonious spenders. So they have excess saving. There's a savings glut. In other words, their supply greatly exceeds their demand. And this is big enough on a worldwide basis to basically put downward pressure on prices. I think that's a fundamental factor. Now, you do have temporary factors, some are reopening the economy, supply chain disruptions, and so on. But if you want to look on this on any time of a time frame, and I'd say 6 months or a year, the downward pressure is on prices.
So you think that'll even be facilitated by the rise in energy prices that we've had this far, because gas has gone up, 45%.
Yeah, well, you've had a jump there. You've had just some disruptions. You had big storms in January on the Gulf Coast, which disrupted production and so on. But OPEC is now increasing their output. They desperately need the money. They've got big spending plans. I look on that as fairly temporary.
So the stock market then, as per our last conversation, you're really concerned about a correction happening at some point. So when will that correction happen, do you think, and how severe will it be?
That's a tough question because stocks are way, way overpriced right now. But what's going to end the party? The Federal Reserve is pumping money out. We've got all kinds of fiscal stimuli, the latest $1.9 trillion. And now we've got coming up the infrastructure and related bills. This money keeps coming out, and you say, what's going to end the party? Could be that things simply get so high that they collapse of their own weight. That happened with the dot-com stocks in the late 90s, and it could happen again. Whether we're close to that point or not, who knows?
And Dr. Shilling, if you think about what's been happening too, I agree with the deflationary pressure we're seeing, especially aging population, et cetera. It's in part a demographic thing. But what we had up till now is not so much traditional inflation, goods and services, but we've had asset inflation because all the money that the central banks are using to flood the economies, that's being saved, it's being invested. So could that be the thing that keeps the market perhaps levitating at a higher value for a period longer than maybe logic would indicate?
Yeah, in our recent newsletter, we talked about the various types of inflation, and financial asset inflation is one of them, and that's what we've clearly had. All the money that's been pumped out, particularly by the Federal Reserve, has not gone into spending on goods and services, right, into new capital equipment and so on. It's really gone into equities.
Mm-hmm. So in other words, not a great thing for savers as interest rates are driven down, but a great time potentially for investors who know what to do with their money. Well,
so far it is. Now, again, as they say on Wall Street, trees don't grow to the sky. And I think, with the height of stocks in relation to earnings and the prospects for earnings and the fact that the economy is opening, but it's opening slowly. And the big question is, are consumers really going to spend all this money? So far, they haven't. You look at the big stimulus that came out a year ago, right, and they saved 79% of it. They saved almost the same amount December's round. We'll see what happened with this latest round last month. But so far, consumers are rebuilding assets. They're cutting back on debt. They're not just sitting there with a bunch of money that's burning holes in their pockets.
We're essentially following the steps of the Japanese from 20 years ago or so. So Dr. Shilling, thanks so much for being such a good friend of the income generation and coming back on the show with us.
Pleasure. Thank you very much.
So right now, let's talk about another key to planning a comfortable retirement, and that's reducing your personal stress level. It's no secret that one of the most common causes of stress is financial and worries about money. And that's why another key to planning a comfortable retirement is having a financial strategy designed to reduce financial stress as much as possible. Now, that may seem obvious at first glance, but even if you understand that a low-stress plan should be your objective, you may not know how to achieve it, or you may not believe that it's achievable at all. And there's nothing anyone can do to completely eliminate stress. However, you can take steps to help reduce it, and typically those are steps that help you pursue good financial health. Usually, Stress stems from two things. And this is good in life in general if you think about it. Lack of control or fear of the unknown. Now, in terms of investing, you deal with both of those quite a bit for most of your working life. Why? Because you're building your savings, which means you're typically invested for growth in the stock market. And when that's the case, you really have no control over whether the investments go up or down in a given day, month, or even year for that matter. Because you never know when the market could take another major downturn. And even though that's more stressful as you get older, it's stressful even when you're in your 30s or 40s and you have time to recover from a financial loss. But because we focus on this show, for those of you in your 50s, 60s, and beyond, the reason it becomes even more stressful at that point in your life is that you not only lose that time that you had on your side, but you're also going to need your money sooner in the form of income. And even if you don't think you're going to need your money because you have a huge pension income, you still do, because if you have IRA money or 401k money, the government's going to force you to start taking income anyway at a certain age. Now, fortunately, the solution to this problem is mentioned in the problem, and that's income. And Jeff and I will talk more about that coming up in just a moment. But now, just one more question from you. Jackie from Florida asks, I have several friends who keep encouraging me to invest in real estate. Is that a good idea when you're close to retirement age? Well, Jackie, it could be, but remember, real estate is not a passive investment. It's active investment. It needs to be managed. So it's not as simple as sitting back and collecting rental checks. And let me first say that I would say rental property is probably the only real estate that is a suitable investment for retirees, because you guessed it, Jackie, it provides you with income. But you have to have the ability to do the upkeep and to be able to handle calls when something breaks down on the property, or have a property manager who could do it for you. But remember, if you have a property manager doing it for you, that essentially goes to reduce your income and therefore your return on investment. So Jackie, thanks for the question, and be sure to send me your questions by emailing us at askdave@theretirementincomeStore.com. And now let's bring back in Jeff.
So Dave, in retirement, folks really want reliability and predictability. They don't want risk, and they want a portfolio that can create a fixed level income. And that's certainly a lot less stressful than relying on the markets to create income, let's say through appreciation.
You're right. You have to essentially, if you think about it, if you're living off that rental income, like Jackie's question just came in, right? If you're living off the rental income and you don't really care as much about what happens to the value of that real estate. If it goes up, maybe you're happy a little. If it goes down, maybe you're stressed just a little. But as long as you have creditworthy tenants in there and you're getting consistent income, then it really doesn't matter at the end of the day.
No, you're exactly right, Dave. And when you compare the real estate synonymous qualities to, let's say, investing by contract through a bond's producing that income. It invests by contract. It's got a par value. You're getting your par value at maturity. And so you've got a guarantee there backing that up. And that's really important than getting a dividend for a common stock that might be fluctuating in share price due to the trials and tribulations of the stock market.
Yeah, and that's not just for bonds. That's for a lot of the things that we talk about all the time, Jeff, in this universe of bonds and bond-like instruments. And at the end of the day, you can do it in the stock market, but the stock market's like that rental property where a tenant can default and not pay you, and then you've lost the income. In the universe of bonds and bond-like instruments, the contract, barring bankruptcy, really essentially minimizes that risk. So, Jeff, great point. We need to take a quick commercial break. And when we come back, we're going to talk more about reducing stress during retirement years. And we're going to bring income specialist in, Andrew Agemy. And you're not going to want to miss what he has to say. Stay with us. We'll be right back here on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to The Income Generation. I'm David Scranton, and we're talking about the 5 keys to planning a comfortable retirement. In just a moment, we're going to bring back in Jeff Small, as well as income specialist Andrew Agemy to help us. But so far, We've discussed holistic retirement planning. We've discussed the importance of goals and a little bit about how to reduce stress. But now let's talk about the importance of having a plan with the right scope, and that's over 200 miles. It's no secret that people are living longer today than ever before. And that's great in many ways, but also creates some challenges, right? And one of the biggest involves retirement planning. And the simple fact that people need to plan for longer retirements than ever before. So if you're a couple in your mid-50s, there is actually a 50% chance, 50, that at least one of you will make it into your 90s. And let's face it, a lot can happen during 30 years of retirement. And that's why we always stress it's so important to have a financial plan that covers the full scope of those years and accounts for every challenge. So what are some of those challenges that you might foresee? Well, how to maximize Social Security. That's one of the easier ones. Maybe even minimizing taxes earlier on. Maybe satisfying RMDs starting at age 72. These are issues that you'll have to deal with. However, if you have a plan designed to deal with them for the next 20 years and you live 25 years, well, now you could be in trouble. But there are other challenges that a plan with limited vision might miss altogether, like the true impact of inflation, as well as the risk of spending down principal. So Dave, I can hear you asking now, what's this whole notion about seeing over 200 miles out in the future? Well, it's an analogy that I make as a pilot. Because if you're a pilot and you're in an airplane, you're flying at 1,000 feet, the horizon is less than 40 miles away. That's all you can see. But if you're flying at 30,000 feet, the horizon is over 200 miles away. So essentially, by flying higher, you can see almost 6 times further. Now, figuratively speaking, most people and most advisors only fly at 1,000 feet. They don't typically see more than only maybe 5 or 10 years ahead into retirement. Part of that's psychological, but part of that is also knowledge. An income specialist, someone who's uniquely qualified to identify those issues relevant to long-term financial planning, is someone who's qualified, in other words, to provide you with an important key for planning for a comfortable retirement. Now let's get to one more question. We have Jim from Massachusetts who says, do you think getting long-term care insurance is a good idea? Well, Jim, here's the simple answer. Long-term care is really designed for middle America. If you haven't saved a lot of money, then it's possible that you don't have enough to really insure and you don't need to spend the money. If you've saved millions of dollars over the course of your lifetime, then maybe you can afford to self-insure. You don't need it. But if you're one of the tweeners, where you've saved enough to care about, but not quite enough to self-insure, well, that's the person for whom long-term care insurance is really most necessary. So thank you for that question. Now be sure to send me your questions by emailing me here at AskDave@theretirementincomeStore.com. And of course, now let's bring back in my buddy Jeff, straight from vacation down in the Florida Keys with his family. Jeff, I'm jealous. I can't wait to do the same thing.
Hey, I'm going back there this weekend, Dave.
Why is it that I don't doubt that in any way?
Anyway, so let's get back to the show here. When you combine an income specialist with a holistic perspective, you end up working with an advisor that sees things from that 30,000-foot level. Most financial advisors miss that because they're on the hard deck. They're only thinking about the things that you got in front of you. But an advisor that's looking at things from 30,000 feet can see further into retirement and help you deal with the issues that you need to deal with a true income specialist.
Yeah, and just it's important, I think, for you to remember, watching, listening. When we talk about income specialists, what we mean is somebody who specializes in working with people during retirement. Not retirement planning leading up to retirement, but income specialist is someone who plans, who helps people during those retirement years. So they basically pick up where the retirement planner essentially leaves off, Jeff.
And that's true, Dave, but you got to be extremely flexible as a planner because you've got to prepare people for their health challenges, for their goals, for their lifestyle issues economically, and what happens in the various decades. Every perspective financially in retirement changes. And so you've got to work with somebody that's going to help you, guide you through that process, and develop that vision from that 30,000-foot level.
Yeah, I mean, first of all, people's goals change as they get older. They spend more money on medical insurance. They have to deal with medical inflation, which we'll talk about in a bit, which is a higher number than the general level of inflation. But also family goals change. Sometimes they get to a point in retirement they need to take care of a parent or maybe a child that can't support him or herself. And not to mention, the 800-pound gorilla in the room is, what if you need to go to a convalescent home? Or what if you don't want to go and you'd rather be able to spend money on full-time home health care? And those are some of the places where an income specialist can shine above your one-of-the-mill generic type financial advisor, quite frankly. And of course, you and I are going to have a chance to talk about that more coming up in a bit. But right now, I want to welcome our next guest, income specialist Andrew Agemy, founder and CEO of Agemy Financial Strategies, right down the street from my office, actually, in Connecticut. Andrew, it's so great to have you back here on the Income Generation.
Hey, I'm excited. Thanks for having me back.
So Andrew, it's great to see you. You're a very successful financial advisor. We spent some time together. You came down to my office and see my operation. But tell me what the turning point was for you to become an income specialist. When did you have that epiphany?
Well, especially when the market started dropping in 2000, and I had recognized that what I had been taught for years and years and years was not, was not in line with what I wanted to happen with my clients, and started looking for a better way of doing things. And that's when I did all the study and changing of my how I do things, and started focusing on income rather than growth.
So really, you changed your business because the dynamic of investing changed, and you saw the tunnel, you saw the light there, so to speak. And so what do you project going forward? Is income going to be the place to be for your clients for the next 5 to 10 years, or are you going to be more pliable and market-based?
Well, when we're talking about people in retirement or close to retirement, the income is still very much apropos. However, yes, we are going a little bit more toward the growth base for those people. We believe in a purpose versus performance strategy. And if people got their money set up to fulfill their purpose, well, the rest of the money they can use for performance to be able to get some growth out of that if that's available. And we believe in that.
So in about 30 seconds, Andrew, when you look at purpose-based investing, you incorporate holistic measures or lifestyle goals into that, correct?
That's correct. And, especially not just the investment side, but how to use those investments, as well as taxation and estate planning, legacy planning, those kinds of things as well. Very important to have all those things involved.
Andrew, what are some of the most common reasons why people don't live a fulfilled retirement, or perhaps why they even struggle financially in retirement, in your experience?
I think a lot of that is fear, right? The fear of running out of money, and then they don't spend it. I mean, I'm constantly telling my clients, spend your money. We got all this income coming in. You don't need it, spend it. I'd rather have you spend it than your kids spend it, because they're going to spend it. And, and they laugh because they come in and they say, see, I told you Andrew was going to say that we need to spend our money.
Yeah, exactly. So really quick, is that the most important reason to make the transition from a growth mindset to an income mindset, from a performance mindset to a purpose mindset as you approach retirement?
To be able to get income, be able to have stability of income, as well as, people want stability in their investments. They want to be able to have income and need income, because you don't need $1 million when you retire. You need a check to replace.
That's right. You need to replace your paycheck, 100%. Andrew, thanks so much for being back with us on the Income Generation. You're always a good friend of the generation. Thank you. And you stay with us. When we come back, we're going to talk about what I personally believe is the number one most important component in a successful retirement plan. And joining us will be income specialist Mike Burleigh, and you're going to want to hear what he has to say. Stay with us. We'll be right back in a moment here on the Income Generation.
Did you know women typically receive less Social Security money when we retire? On average, we earn less money than our male coworkers. We're also more likely to take a break from the workforce to raise children. women generally receive at least 15% less in Social Security benefits. Have you done all you can to maximize your Social Security? Visit womeninretirementnow.com and download our free Women's Guide to Retirement Planning. Learn more about the challenges women face in today's world, as well as unique solutions to achieve your retirement goals.
Welcome back to Income Generation. I'm David Scranton, and it's great to have you here. Of course, I'm with Jeff Small, and in this segment, we have income specialist Mike Burleigh coming aboard from the great Sunshine State of Florida. And so far, we've covered 4 keys to planning a comfortable retirement. We've covered planning holistically, planning with specific goals in mind, planning to minimize stress, and planning from 30,000 feet. In other words, 30 plus years through retirement. But now let's talk about the 5th key, and that's important of flexibility. Now, when I say flexible, I don't mean a plan that you can change on a dime, right? I mean a plan that you can adapt as needed, preferably with the help of an income specialist. And those changes are usually based upon changes in your life. As I'm sure you know, the only constant in life is change. Your situation, your goals, and even your risk tolerance level might change. And that's why it's important to have a strategy that can adapt to those changes. A strategy that an income specialist can help you with and help adapt the plan on your behalf to help minimize risks and maximize opportunities in all market conditions. Remember, the financial markets are constantly changing also. And while things don't shift as dramatically in the universe of bonds and bond-like instruments as they can in the stock market, they do shift. And we've seen some big changes recently. However, that advisor, that income specialist, uses diversification and various strategies in the income world to help ensure that you're getting some protection and getting a respectable level of income that you can enjoy during retirement. And that protection comes even in the face of rising interest rates. So for example, while some bonds have had a headwind recently, other income generating options like REITs and BDCs have done quite well. Now, those investments, of course, carry more risk than individual bonds, but they can actually help you lower your risk when interest rates rise if you pepper a little bit of those types of things into a portfolio of bonds and bond-like instruments. In addition to that, as you can imagine, as conditions change, you always have the option to meet with your advisor and to talk about modifying your strategy to suit those changes. Now let's take one more question from you. Jacob asks via social media, Dave, what are your thoughts on selling covered calls on stock holdings to generate income? Well, Jacob, I love it as an income strategy because, as you know, if you have higher dividend paying stocks, if you know what you're doing, can differentiate between value and value trap, as we've talked about on a recent show, then you might be able to get as much as a 4% dividend yield or a little higher right there. But now if you write covered calls, you can almost double that income. Now, of course, the downside is the stocks that really run up means the stock might get called away and you might not own it. But again, if your primary objective is investing for income and your secondary objective is growth, then covered calls can be a great strategy. And Jacob, I don't know about your level of sophistication in that, but I would say for most of our viewers, most of our listeners, it's a great strategy, but you may not want to try this at home. Be sure to send me your retirement questions by emailing me at askdave@theretirementincomestore.com. And now it's time to bring back in the newly suntanned Jeff Small.
So Dave, me having a tan is like a holistic plan. You got to get your vitamin D. It's a lifestyle goal to stay healthy, right?
You're right. I work too hard. I have to learn from my good buddies what I have to do.
No, you're the perfect model for that. But getting back to the topic here, there's lots of ways to prepare and plan for income and retirement, Dave. Some are more riskier than others. It's very vital that you find an advisor who's going to educate you on the pros and cons of income-based investments and the universe of income-generating options.
Yeah, as you know, Jeff, some people want to focus on the more conservative things. Some people are willing to get out into some of the more aggressive things a little bit more to increase their yield. But most importantly, people need to understand that if you add a little bit of the riskier stuff to the more conservative stuff, at first it lowers your risk. If you add too much of the riskier stuff, because you get too greedy, if you will, then it goes out on the edge and you're taking more risk. And that's where people like myself and you and our guest coming up, Mike Burleigh, really help people manage the risk to people's own personal risk tolerance levels.
Very true, Dave. You know, today we still get lots of questions on how to keep up with inflation. And, you know, dividend reinvestment is a great way to do that. So if you've got a portfolio that's generating 5% and you're only taking out 3%, you can plug 2% back into your portfolio and buy more income-based investments to keep up with that inflation. And that is really the best way to keep up with inflation today. Dave, what do you think?
Yeah, and in theory, in the stock market, you don't have to do that because you get a hedge through the increasing dividends. But in the universe of bonds and bond-like instruments, that's where that strategy is so incredibly important, Jeff.
And in retrospect, Dave, on everything we've covered today, the most important thing the viewers and the listeners have to know is they've got to have the right advisor to navigate through the world of income-generating options. Some of them will choose to go it alone, and maybe they can do half of it correctly, but the other half is going to require working with an advisor that specializes in income.
Yep. And speaking of that advisor, for those that are somewhat south of where you are in Melbourne, around the Jensen Beach area, that brings up our next guest, income specialist Mike Burleigh. Michael is president of Peak Capital Management. Mike, it's always great to have you back on the show as you're a true friend of the income generation.
Hey, thanks for having me back, Dave. Appreciate it.
Michael, it's great to see you. You know, you and I have been working together. We've known each other since about the last 20 years. And so, you know, quickly, give us your rendition on how the business has changed over the last 20 years. How our business has changed.
I think our business has changed as far as planning for retirement. You know, in my lifetime, one of the biggest differences is you don't see as many defined benefit plans as you used to. The old-time pension plans, if you will. You know, you work for the company 30 years, you get the gold watch and the check. Those have kind of gone by the wayside. The onus has been put on individuals now to kind of try to figure that out for themselves.
Well, I think that's a great point, Mike. I mean, pensions have gone the way of extinction, so to speak. So it really means that, you know, if people want to create income, they got to work with a specialist who understands all of the income options. Wouldn't you agree?
Yes. You know, the phase of retirement is all about income. You can't really eat growth, so to speak. And, you know, retirement today, you could be in retirement 20, 30 years. So, you know, that money's got to last. I think the biggest fear that I see with people coming into my office is, you know, number one, am I going to have enough? You know, I won't run out of money the rest of my life. Will I have enough income to live on? So that's the challenge for most people.
That was an amazing thing you just said, Michael. You said you can't eat growth. What does that mean? Can you elaborate on that?
Well, you know, when you get growth in a portfolio, it's nice to have the growth. And in your working years, you're trying to accumulate as much as you can. But when you get to the retirement phase, you really need to invest for income. You need interest and dividends, something, the bird in the hand, if you will, that you can take out of your portfolio to live on. You can't really spend the growth because you could deplete the portfolio too quickly.
And isn't it true, Mike, that in some ways, too, it's gotten a lot tougher, not just because of the disappearance of the pensions, but it's also more difficult because of the downward pressure we've seen on interest rates really over the last 40 years.
Well, yeah, it's made a big difference. I mean, you think back 20, 25 years ago, it was kind of simple. You know, you could go down the bank and get a CD for 5%, right? And live off the interest on that CD. Today, it's a different world. You know, interest rates on CDs are, you know, maybe 1%. So you have to be able to work with somebody who specializes in that income-based model, where you can create enough interest and dividends to supplement your retirement, your Social Security, if you will.
And again, in your experience, I think you find, like we do, same types of income streams. So if done properly, if done perfectly, which, you know, doesn't happen often unless they work with income specialists like yourself, $1 million generates roughly how much retirement income net for the retiree?
Well, today, net of fees, you know, you could probably generate about $40,000 a year. I mean, that's realistic today. Yeah,
and you're right. When you said late 90s, heck, you could have gotten that from a bank CD. You could have gotten 60 or 70 from a bank CD, but now you can't. And I think
in your treasury, the world's changed. So It takes a lot more work today to generate that kind of income.
The world's changed, and what I love and respect about you so much, Michael, is that even though you've been in business since, you know, early mid-'80s like myself, you've stayed current with it. So, Mike, thanks so much for being back with us once again here on The Income Generation.
I appreciate it, Dave. Thank you.
The good life. right? We all want it, but we know that you can't get it just by having a lot of money. And naturally, it's important to save as much as possible before retirement, right? But it's even more important to have the right plan. And again, that's a plan that helps to protect your money and to make it a reliable source of income. As we've seen today, there are also several other important keys to planning a comfortable retirement. So let's review briefly. Making sure you have a holistic retirement plan. Making sure your plan aligns with your goals. Making sure it's a plan designed to help reduce financial stress. Making sure it sees the full scope of your retirement from 30,000 feet, in other words, at least 30 years ahead. And last but not least, making sure it's flexible enough to keep pace with one constant in life. You guessed it, that's change. Thanks again for joining me on The Income Generation, and thanks to Jeff Small as well as all of our guests. We've had a great time being with you today. And if you're close to or you're in retirement and you're concerned about your money, as you know, it's essential you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week.